expect a strong recovery in the aluminum foundry production. Why? Mainly coming from the automotive industry. If you bring a new battery into a car, for example, a Jaguar, the weight of the total battery, even if it's done in aluminum, is around 204 kilograms. It replaces a classical power engine, which weighs, including the gears, around 96 to 98 kilograms. We see a strong improvement in the next years in the refinery production. Last year, the total mining production came a little bit down, mainly as a result of developments in Peru, where a lot of mining workers were affected by COVID-19. And therefore, the global mining production was a little bit lower, but the refining output increased. We see a high substitution in the automotive industry, and we see, therefore, only a little bit higher needs in some other segments, but it will stay on a very low level. It will not have an as significant growth as in the next years. And we even expect that in the current year, we will see another oversupply in the global lead market. The zinc mining production came also strongly down in the last year. It fell by around 6%, and we saw a lot of interruptions in several mines, mainly in Asia and Latin America.
To get started, it's obviously important to start from the beginning, and with lithium-ion batteries, they have, of course, been commercial for a few decades now, but we are very much at an inflection point where we see demand growing pretty significantly over the next 5 to 10 years. And the vast majority of that will be coming from the growth in electric cars and electric vehicles more broadly. And so while EVs still account for only a relatively small percentage of the overall market, we do expect that picture to change pretty drastically over the next 10 years. You can get an outlook, a forecast for where we see copper demand from lithium-ion batteries going over the next 10 years or 8-9 years in this case. And the overall trend is pretty clear. There is an upward trajectory, as you would expect. And as part of that, it's because we don't see anything replacing copper within the cell and as a current collector foil or as a conductive material for wires and connections and so forth. And the majority of demand, as I mentioned before, is going to come from the automotive sector, from electric vehicles and electric cars, and as well as other forms of mobility, of course. And that has repercussions for who is locking in supply, and also kind of the money that's going into lithium-ion technology from an R&D and development perspective, with most of that tailored towards vehicle electrification. And this story with copper demand increasing for lithium-ion batteries is a story you could pretty much tell for any of the other materials within lithium-ion, within the lithium-ion cell and battery. And this has repercussions for, of course, the amount of investment that's perhaps needed soon to ensure that demand can be met. And so even looking at things like cobalt, where completely there has been discussion of trying to reduce the amount of cobalt in the cathode material and therefore within the lithium-ion battery, completely eliminating it is not a trivial task by any means, and different applications will require different materials to be used, and things like high nickel, zero cobalt cathodes are not going to be optimal or even suitable for a good number of applications.
And here's just, we have a data from Jan 2020 until the end of February. So it's just to give everybody a sense where we are in terms of the price direction. So tin, has risen the most in that period, is up 49%, then followed, by copper with 47%, nickel 30% higher than in Jan 2020, zinc 21%, aluminium at 19%, and lead at 7%. So pretty much would say a recovery since the beginning of Jan 2020 across the board, with all the metals in positive territory. over that period. Certainly last year, sort of the peak of trading activity we saw in March 2020, during the kickoff, let's say, of the COVID pandemic. Then volumes have sort of drifted lower after a very volatile month in March 2020. But we've seen from the December 2020 levels, we've seen an increase now in the first quarter in both January and February in our daily volumes. And we've basically in February, we've reached levels almost, that we've seen back in May, roughly, sorry, in May and June last year. Here, I think it's an interesting graph. What we show here again, just electronically traded on LME Select. We're showing our average daily number of trades per hour. And what we've seen so far in 2021 is that actually there's more trades happening during the Asian Open between 1 and 2 o'clock at night UK time, and as well from sort of 12 o'clock midday till 3 o'clock UK time. And that's, both compared against 2020 and 2019, we've definitely seen more trading activity in those time buckets.
Higher risk for a downside development is that we will have a lot of more problems with COVID-19 disease than we expected. In some countries, the vaccination is not very well doing, especially in Germany. And if we have a third or fourth wave, which will bring shutdowns in the manufacturing industry or will affect mines like in the last year in Peru or in some other countries, we will see a high downside risk for the development.
For long-term risk to EV adoption, I think it's important to note, at the moment it's still pretty much driven by subsidy. So obviously when those get taken away, it becomes a slightly different picture. And then I think you do kind of, again, longer term, you do have some bottlenecks with regards to certain materials that you need for lithium-ion batteries. And I think there's quite a bit of investment needed in certain segments of that supply chain. And you do have bottlenecks which could still derail this. I think would be the 2 points I would highlight.
I see one risk for the global cobalt production. We should become a little bit more independent of the Congo, because we have seen high risks, high political disruptions in the Congo during the last decade. And I believe it's very, very quick necessary to improve the production plants outside the Congo.
Obviously, as I've shown, quite a lot of data was based on our LME Select platform. So there, obviously, we have a membership structure where a lot of clients can, on the one hand, can get a trading platform by some of the category 1 and category 2 members, which will then allow them to trade the LME markets. The other option as well is there's a very active inter-office market. That means a lot of the business is still conducted on the telephone. So that's another option, especially on the options market. As you know, Robin, this is definitely still very much a phone-based or broker-based options market. And unfortunately, obviously, the last venue how clients were able to trade in the past is the LME Ring, which has been shut since the COVID pandemic in March last year. But as I said, you can definitely execute electronically. You can go to your members. And obviously, most of the large banks who are either members or who are not members will have definitely access to the LME markets as well.
In my opinion, we will see in a very quick way, shortage in the copper markets, because we forecast the copper demand of 28 million metric tons in 2025. Last year, we had a production volume of 24.42 million tons, and this could be a market which will be during the next 2-3 years in a deficit, and this will hold the prices very high.